Hey guys, welcome back to Student Loan Methods. I'm Nest Egg. I'm Jennifer, money coach, personal finance educator, and student loan guru to Gen Zers and young millennials. Last week, we talked about the most common mistakes to avoid when refinancing your private versus federal student loans. This week, we're going to walk through the repayment options you have when it comes to paying off your federal student loans and how to choose the right one for you. We're here every Sunday with new saving, investing, and retirement tips and strategies. So if your goal is a debt-free, financially free life, hit the subscribe button and turn on the bell. You'll be notified immediately whenever we post our latest and greatest money moves each week from New York. Student loan debt in the US is close to a record high of nearly 1.7 trillion. Over 1.5 trillion of this federal student loan debt is held by about 42 million borrowers. In fact, even when you look at our clients, the average amount of federal student loan debt that they have is $200,000. So you're not alone. But does this mean you have to live with this debt for the rest of your life? Absolutely not. But it does mean that you have to choose wisely when it comes to selecting a federal student loan repayment plan that works with your finances, where you're actually paying down your balance on a steady basis, and that there's an end in sight. Which federal student loan program are you currently on? And how's it working out for you? Drop us a comment below and let us know. The federal government offers you a lot of flexibility when it comes to repaying your loans. The default option is the standard 10-year repayment plan, where you pay a fixed monthly amount over a 10-year period. And you'll be put on this automatically if you do not tell them that you have another preference. The standard 10-year repayment plan is the fastest way to pay off your loans, and you'll be paying the least amount in interest overall. Because remember, the quicker you pay off your loans, the less interest you'll be charged. The downside of this plan, it also has the highest monthly payment because of the short repayment period. This was the plan I went with after racking up $50,000 of student loan debt in business school, despite getting a partial scholarship. Now, some of you are probably thinking $50,000, that's nothing. But remember, this was nearly 2 decades ago, so it was a lot then. And I still think it's a lot now, quite frankly. At any rate, I chose the standard plan precisely because I wanted to get rid of my student loans as quickly as possible. But it was hard work, no joke. I worked day and night, cut out all discretionary spending, and ate ramen practically every day. And I love ramen, but at some point, even that got a bit old. But I paid everything off in less than 2 years. So it is doable, albeit with lots of effort, persistence, and a bit of short-term pain. Having said that, most of the folks that we come across are not usually on the standard plan because of the high monthly payments. This can be really difficult to manage when you're coming straight out of school. However, if you have no intention of applying for public service loan forgiveness and you can swing the high monthly payments, this is the way to go because it is the fastest way to pay off your federal student loans, and you'll be saving the most money when it comes to overall interest paid. The second federal student loan repayment option you have is the graduated repayment plan. This is also a 10-year plan, but it starts with lower payments that increase gradually, usually every 2 years. This may be suitable for you if your income is currently low, but you expect it to increase steadily over time. Even though it's also over a 10-year repayment period, you'll still end up paying more interest under the graduated plan than the default standard plan that we spoke of earlier, because your monthly payments in the beginning are lower. The third federal student loan repayment option that's available is the extended repayment plan. Under the extended plan, you make lower payments month to month than you would with the standard and graduated plans. But you make these payments for a longer period of time. You can choose a fixed or graduated monthly payment and a repayment period of usually between 12 and 25 years. While the monthly payments are more affordable because you're taking longer to pay off your loan, you'll be shelling out more for interest over the lifetime of the loan under the extended plan than with the other two plans we just spoke of. So far, we've talked about the standard, graduated, and extended repayment options for federal student loans. Now, let's move on to the income-driven repayment plans, which are probably the most popular options. There are 4 types of income-driven repayment plans, and they are income-based repayment, also known as IBR, income contingent repayment, also known as ICR, pay-as-you-earn, and revised pay-as-you-earn. Those of you that are on one of these income-driven repayment plans, you're eligible to apply for public service loan forgiveness, also known as PSLF, as long as you also meet all the other necessary requirements. Now, the success rate for PSLF applicants is fairly low at the moment, at roughly 2%, primarily because it is a fairly new program, and most applicants are simply unaware of all the things that they need to do to meet the requirements. Literally, you need to dot all your I's and cross all your T's. Given the complexity of the topic, we'll be doing a separate PSLF video in the coming weeks. So hit the subscribe button if you want to learn how to successfully apply for public service loan forgiveness. We'd love to hear from you. Let us know if this is something that you're working towards in the comments below. So back to these income-driven repayment plans. All of them generally adjust your monthly student loan payment to between 10% and 20% of your monthly discretionary income, which takes into account your family size as well as the state that you live in. Depending on the income-driven repayment plan you're on and when your loan was taken out, you're also eligible for loan forgiveness after 20 to 25 years of consistent on-time monthly payments if you still have an outstanding student loan balance. Do keep in mind, though, that any loan amount that is forgiven is considered a gift to you from the government, which means that it will be taxed. So it may make sense to calculate how much in taxes you'll owe when the loan is forgiven. You can also consult a tax attorney or an accountant. These are the federal loans that are eligible for income-driven repayment plans. Any subsidized and unsubsidized loans, any direct graduate plus loans, any FFEL consolidation loans, and any direct consolidation loans. If you want to learn more about the different income-driven repayment options, I've included a link to the student8.gov website in the description below. Now that you know all the federal student loan repayment plans that are at your disposal, you'll need to calculate how much you can afford to put towards your student loans each month. If you already know what this number is, that's awesome. You're already one step ahead of the game. If you don't know what this number is, no need to worry. Simply download the financial guide. It's right below this video. Grab your budgeting template and let's figure this number out. You can also check out this video here. It goes through any money habits in your life that you might be able to adjust so that you can start setting aside a bit more each month to pay off your student loans just a tad bit quicker. Once you have the number that you can afford to pay each month, the easiest and quickest way to figure out the repayment option that's best for you is to use the loan simulator that's on the student8.gov website. That way, when you call your loan servicers, you'll have all the information you need in front of you. So here's the loan simulator webpage. If you log into your account, all your loan information and interest rates will be pulled directly into the calculations. But you can also enter your loan information manually by clicking on Start from Scratch, which is how I'm going to do it because I don't have any student loan data in the system. And what follows is a page with some personal information that you need to fill out. So for the sake of simplicity, let's assume that I have a job or plan to get one soon, that I filed taxes in the last 2 years, and that I'm single with no dependents and nothing else here applies to me. Then I click continue. My tax filing status is single. We're going to pretend that I live in Alabama and that my yearly salary is $60,000, growing at a rate of 2% per year, which is what the national average is. Here, you'll have to enter your loan information. Again, you can log in. You can see here, you can use the specific school information or use national loan data. Let's go to a specific school and we can use one of my alma maters in New York. Let's see if it's here. New York University. And what shows up is the typical loan balance for a student there, which is $21,250. And the average interest rate, which is 3.9%. We're not going to apply for public service loan forgiveness. Otherwise, it complicates it a little bit. And that my primary repayment goal is pay off my loans as fast as possible. Then I click on View Results, and it runs the calculation for me. And you can see here, it estimates that the repayment plan that is best for me is the revised pay as you earn, repay. And this is the amount that I have to pay per month that's estimated, and this is when I should pay it off. If we pretend now for a moment that despite my best budgeting and saving efforts, I can't afford to pay this much. Maybe I can only afford to pay $200 every month towards student loan repayment. I can go to the right side here, click on monthly payment I choose, put in $200, and then go to Apply Changes. And you'll see that they give me a new estimate based on my budgeted number. Now, because I'm paying less than in the previous plan, I now won't be able to pay off my loans until November 2032, which is roughly 6 years later. And I'll also be paying more in total interest. And we take this one step further. Let's assume that I'm going to apply for public service loan forgiveness. So I'll turn this on, click on Apply Changes, and it'll show me how much will actually be forgiven and when I'll be paid off. As you can see, the loan simulator can be quite a nifty tool, and you can spend a fair amount of time playing around with the different scenarios, at least when you're a bit geeky and curious like us. Keep in mind, though, this tool can't accurately predict your future payments 100% of the time. So once you're armed with all your info, the next step is to call your loan services. Your loan servicers are the ones who will be able to provide you with the most accurate, up-to-date numbers and make the necessary changes to your repayment plan. They'll also be able to guide you through the rest of the process. For example, if there's certain documents you need to submit, they'll let you know what these documents are and when the deadlines for submissions are. For those of you that may be thinking of snagging lower interest rates and refinancing your federal student loans with a private lender, take a look at this video first to make sure that you're ready to give up the flexible repayment options we just talked about, as well as all the other benefits that your federal student loans have to offer. Thanks for watching. We really appreciate your support. If you found this episode helpful, give us a like, hit the subscribe button, and turn on notifications. It really helps with the YouTube algorithm and spreading our financial education efforts to other Gen Zers and young millennials. See you again next Sunday when we'll be back with even more awesome tips on student loans. In the meantime, check out our other personal finance videos, and if there's any topic that you'd be interested in learning more about, pop in a comment below and let us know.